Welcome back to the deep dive. Today we are focusing on a market event that has really caught everyone off guard.
From traders to, even engineers who use this stuff.
Exactly.
Yeah.
We're talking about the explosive, completely unprecedented surge in the price of silver. This is not just a good week for a metal. It's a commodity that just blew past a record set 45 years ago.
That's right. And the sources you provided, they give us a kind of roadmap to understand the sheer financial shockwave here. For you tuning in, our mission is really to peel back the layers.
To figure out why.
Yes, why the paper market is screaming one thing while the physical supply chain is, well, it's screaming something completely different.
Okay, so let's unpack this with the cold hard facts first. The headline itself is jarring. Silver struck an all-time record high of $59.32 per ounce.
$59.32.
On December 5th, 2025. This historic spike, it reflects a year-to-date increase of somewhere between, 88 and 98%.
Think about that. Nearly doubling in value in just 1 year. And that spike, it really defines the central tension of this whole deep dive.
Which is?
We have this robust, sustained physical industrial demand colliding head-on with rapidly dwindling, verifiable inventories at the COMEX exchange.
So the market is suddenly waking up to this gap between paper promises and physical reality.
It's a vast gap.
Let's start with that immediate price action then. That record high, the $59.32, came before the price settled back a little. It was trading the $58 range after that.
Right, between about $58.28 and $58.59.
But even the lead-up was just shocking. A 21% rise over just the prior month alone.
And when you talk about significance, you have to anchor it to history. This metal, it officially surpassed its previous peak of $49.95.
From way back in January 1980.
Exactly, 45 years ago. And that high watermark was largely a product of a very specific, aggressive market manipulation attempt and, a period of rampant inflation.
That's the key difference I find so fascinating in the sources. In 1980, the price was driven by speculators trying to corner the market.
Right, during a crazy inflationary period.
Today, the driver feels fundamentally different.
It absolutely is. Today's peak is less about financial panic and far more about a structural scarcity. It's driven by industrial need.
So what's the so what of this $59 price?
The so what is that it signals an immediate acute threat to physical supply. For 45 years, that $49 level stood as this unbreakable ceiling, and now it's gone. It's confirming the market's deepest fears about physical stock levels.
And just to show how global this is, the sources give a quick comparison. In India, local prices were sitting around 190 rupees per gram.
Yeah, and when you run the conversions and factor in local premiums, that translates to roughly, $36 an ounce?
So a huge difference.
Yeah. That specific comparison is so important because it highlights the friction and the premiums that pop up when physical demand surges. The spot price might be one thing, but if you want the actual metal in your hand, you're often paying way more based on local supply and currency.
And when the metal gets hard to source, those regional gaps just blow out.
And that puts even more stress on the global price.
Okay, so the price confirms the fear. Where is the fear coming from?
It's coming directly from inventory reports, specifically at the COMEX.
Right, and to understand the squeeze, we have to talk about the two main categories of silver in their vaults: eligible and registered.
This is the most crucial distinction for you to grasp. Eligible silver is metal that's stored in COMEX vaults, but it's not immediately available for delivery against futures contracts.
So think of it like stored wealth. It's there, but you can't use it to satisfy a contract today.
That's a great way to put it. Then you have the other pool,
Which is registered silver.
registered silver. This is the metal that's available right now to satisfy delivery obligations. If you buy a contract expecting to take the physical metal, this is the pile it comes from.
So registered stocks are the only true measure of market liquidity.
It's the exchange's ability to handle physical demand. Yes.
And here's where the source material gets, alarming. Registered silver stood at roughly 113 million ounces in late November 2025.
113 million.
But early December reports showed that over 60% of those registered stocks were claimed and withdrawn through deliveries.
60%. This isn't a gradual trickle. This is a rapid drain of the immediately deliverable supply.
The velocity of that is what's so shocking.
It is. The ratio of registered stock to open contracts. That's what traders watch. The sources mention historically tight markets where this ratio dropped to, 11%.
But when 60% of the deliverable pool just vanishes in a short time?
You're risking an immediate liquidity crisis. The exchange is now under intense pressure to replenish those registered stocks, either by reclassifying eligible metal or importing new supply.
Okay, but let's dive into the supply side. What's holding that replenishment back? It's not like you can just order more silver.
Precisely. We're up against some really deep structural constraints. Global mine production has actually declined. It's down 7% since 2016.
There's no quick fix.
No. A huge amount of silver, maybe as much as 2/3, is extracted as a byproduct of mining copper and zinc.
So we can't just open a new silver mine to meet the demand. The supply is fundamentally tied to totally different industries.
That's the structural challenge. If copper and zinc demand aren't spiking, the silver supply stays inelastic. It's very, very hard to ramp up production just because the price shoots to $59.
And this imbalance isn't new. Our sources note the market has faced a structural deficit, meaning demand exceeds supply, for 7 years straight.
7 years, running through 2024. And the projected deficit for 2025 is still massive, somewhere between 117 million and 206 million ounces.
So this is the 5th year in a row with a major supply gap.
A gap that has to be filled by drawing down inventories, including the very inventories we're seeing grain from the COMEX right now.
That leads us straight to the demand side, which is what's driving this whole thing. That 59% industrial use number. That's the story of the future, isn't it?
It is the defining feature of this market cycle. Industrial demand hit a record high in 2024.
And that was the 4th straight year of new peaks.
4th straight year. This is not speculators buying bars. This is fundamental consumption. It's based on silver's unique properties.
Let's get specific. When you look at the green energy transition, silver is. It's absolutely essential.
It's the wiring and coating of the future. Solar panels consume huge volumes for their conductive coatings. But think bigger. The entire EV infrastructure.
Electric vehicles.
EVs require 3 times more silver than a traditional car. 3 times! Every time we replace a conventional car with an EV, we are tripling the silver demand from that one vehicle.
And it goes beyond just cars and solar panels. Where else is this metal being, silently consumed?
Look at data infrastructure.
Yeah.
5G networks, massive AI data centers, they all require incredibly efficient connectivity and heat dissipation. That's where silver excels.
The medical devices too, right?
Plus medical devices for its antibacterial properties. So every time the global economy gets smarter or greener, it eats more silver.
So what does this all mean for the broader picture? This demand feels completely baked in.
It confirms silver is no longer just a monetary metal. It is a critical industrial commodity. The sources directly connect this surging demand to mandatory green energy transitions, and importantly, silver's designation on the U.S. critical minerals list.
So not a temporary bubble.
This is not a bubble driven by sentiment. It's a structural repricing based on electrification and a very finite supply.
Okay, so if the supply is this tight and the demand is structural, then we have to look at who is holding the remaining supply.
Right, the financial architecture.
Which takes us back inside the COMEX vaults to talk about concentration risk, specifically JPMorgan's role.
This is where the paper market meets the physical supply chain, and there's a huge potential conflict of interest. Reports estimate JPMorgan holds around 169 million ounces in COMEX vaults.
That could be 40% of the total inventories.
40%. And the accumulation has been vast, something like 675 million ounces since 2011, after they acquired Bear Stearns.
But the sources highlight this crucial detail. The bank reportedly reclassified 134 million ounces from registered
The deliverable supply.
to eligible status.
That move, whether it's for risk management or something else, essentially pulls a massive chunk of deliverable metal off the market just as registered stocks are being drained at a 60% rate.
It reduces the immediate liquidity cushion.
Drastically, during a period of peak stress.
But wouldn't that look to outsiders like an attempt to tighten supply at the exact moment everyone is demanding delivery? I mean, what do the sources say about intent?
The sources just report the fact of the reclassification and its dramatic impact. The intent is, well, it's debated. Some say it's prudent risk management, others see it as exerting control. But the effect is undeniable.
It amplifies the scarcity.
It forces people to ask, who controls the flow and what happens when they manage their metal this way?
And speaking of strain, there were other explicit signs of stress, like that COMEX outage on November 28th.
That outage wasn't just some inconvenience. It lasted over 10 hours. And it immediately caused silver to spike to $56.72.
The widened bid-ask spreads during that.
Yeah.
It's a huge red flag.
It's a classic signal. When an exchange halts and the market seizes up with that kind of volatility, it tells you the underlying derivatives market is highly illiquid and very vulnerable.
And that vulnerability exists because of the massive leverage. The COMEX open interest, the paper contracts, reportedly reached a staggering 244% of vaulted silver.
244%. That's like having almost 2.5 people trying to buy the same single coin.
So how is that possible?
It only works because everyone assumes they won't all demand the physical metal at once. But if even a moderate portion of them do, the system breaks.
The sources mention other stress indicators too.
Yes. Silver lease rates peaked at 30% annualized in October. A staggering number. That's the cost of just borrowing physical metal. It's an extremely tight supply signal.
And it reminds me of 2020.
A powerful reminder of the COVID disruptions, where physical coins were trading at 60% over the spot price. The official paper price was completely disconnected from the real-world cost.
Let's connect this back to history. We mentioned 1980 already, but the Hunt brothers incident is the famous parallel.
The Hunt brothers story is the ultimate cautionary tale. The paper versus physical battle. They tried to corner the market, accumulating an estimated 200 million ounces.
And that effort drove silver to $49.45.
What's fascinating is when you adjust that 1980 price for inflation to today's dollar, that peak would be about $170 per ounce.
Wow. That really puts the current $59 in perspective. So if the market were to replicate that sheer panic, there's still massive upside potential.
It shows the historical ceiling of what's possible under extreme stress. And that 1980 squeeze led to COMEX changing the rules. They brought in position limits to stop single entities from ever doing that again.
We also have the more recent memory of 2008.
That's the second phase of this analyst framework. The failure of paper assets after 2008 prompted massive shifts into physical metals. Gold rose 167% from late 2008 to 2011.
So analysts are framing this current run as the break phase.
Exactly. The framework is 1980 was the setup through manipulation, 2008 was the expansion driven by money creation, and today is the break phase.
Characterized by inventory stress and industrial demand.
Right. And the lesson is the same across all three periods. Huge mismatches between derivatives and physical supply amplify volatility to incredible levels.
So let's pivot to what you should be watching right now. The immediate catalyst is the upcoming Fed meeting.
The Fed meeting on December 9th and 10th is a massive inflection point. Market probability suggests an 85 to 87% chance of a rate cut.
And rate cuts tend to weaken the dollar.
Which generally provides a tailwind for precious metals. Any surprise there will cause instant volatility.
And beyond the Fed, what specific inventory thresholds should we be watching?
The big one is registered inventories falling below the critical threshold of 50 million ounces.
50 million.
We're already stretched. A move below 50 million is a massive, undisputed stress signal for the futures market.
And what about the gold-silver ratio?
It's currently around 72 to 1. 72 ounces of silver to buy 1 ounce of gold. Historically, the geological average is closer to 15 to 1.
So a big gap there, too.
A huge gap. If we see that ratio compress sharply, say down toward 60 or 50 to 1, it signals massive outperformance for silver. It would mean the market is prioritizing silver's industrial and scarcity value.
And of course, keep watching ETF inflows and those lease rates.
Those are ongoing indicators of the appetite for physical metal.
That brings us to the end of our deep dive. We've mapped out a scenario where long-term industrial need and a 7-year deficit have finally met a highly leveraged paper market.
Leading to explosive, record-breaking prices and acute physical inventory stress.
And that leaves us with a final thought.
Here's a final provocative thought for you to consider. Silver is absolutely non-negotiable for global electrification and the green energy future. It is a critical mineral. Yet, its price is governed by the vulnerability and concentration risk of a financial derivatives system.
The tension is immense.
So what truly happens to the global energy transition if that fundamental industrial demand accelerates faster than the major exchanges can actually source and restock their deliverable silver?
That is the essential conflict of the modern commodity market. Thank you for helping us synthesize these powerful sources. We encourage you to continue your own research and verify this data via official channels like the CME Group and the Silver Institute. We'll talk to you next time.